not just for First Mutual Holdings, but for the country at large. The Public Accounting and Auditors Board has issued guidance as of 21 March 2019, which is why we are having this analyst briefing today, a month later than was supposed. Guidance was being awaited for that. In 2019, I think things will be more on an even keel. You can make a comparison. It might result in the accounts being restated for the December 2018 year end. Otherwise, if you don't do that, you will continue with the qualification of the accounts into 2020. And nobody needs that. So, unfortunately for me, I'm not a member of the accounting profession or the PAB or whoever that is. But I think that we got to get to that consensus in terms of either we restate our numbers properly, the December numbers, so that 2019 doesn't carry another qualification. In terms of the Botswana business, I've already said, we converted from Botswana Pula to US at 1-to-1 with RTGS. That's the background. The numbers, in terms of the totals as you see them, where it says pro forma, it lists the acquisition of Nichols Diamond, which as of last year, December, we only accounted for 1 month of its revenue. So the pro forma says if we had accounted for a full year. So you see the revenue, they're moving from 124 million to 180 million RTGS dollars. Split 63 million First Mutual Health, 28 million First Mutual Life policyholder business or savings business, 16 million First Mutual Life risk business, 27 million First Mutual Reinsurance, and 46 million Nichols Diamond TriStar. And you can see the big growth on the short-term insurance compared to the prior, which was one of the reasons for that strategic acquisition. We believe that coming out of that, we are better placed to be either the first or the first second in the market in terms of that space. The operating profit there increasing by 22 or 37%, whichever one you take, from 8.1 million to 11.1 million. Profit before tax, 25 million, and profit after tax, 17.7 million. That's the summary of the performance of the group. We remain committed to our ethos of creating economic dignity to our stakeholders through risk management, wealth creation, and wealth management. So the SBUs, which is where you meet the market, I'm going to run through them in terms of how they performed. First Mutual Health, which is the biggest unit in terms of revenue and profitability this far, showing an increase of 11% in revenue and a 9% growth in operating profit from 5.8 million to 6.3 million. Just the statistics that you see there, the membership increased by 15%. The claims paid also increased by about 4 million, which is 9%, mainly as a response to the increase in price of drugs and others. The admin expenses increasing 32%, largely driven by the effect of inflation, particularly on the IT cost and also on the enrollment of people on the biometric processing of claim system, because it's kind of charged in a card that converts. So the claims ratio there remaining almost static, 78%, 79%, little bit better by about 1.27%. Move on. Okay. First Mutual Life. This is the mother business. Sometimes confused with the holding company. As you can see, the revenue going up 23% from 35 million to nearly 44 million, and the operating profit static at around 5 million in both years. The main point to note there is the increase in savings business. That is a hot potato. Most of the pension fund members who are living somewhere else coming with their capital at First Mutual, so we need to ensure that we can protect that investment. And that's not going to be simple, but that's the reason for that many single premiums coming through. Then we've got our risk business growing by 7%, mainly driven by the EFML, the flexible mobile funeral cover, giving us that total there of 43.5 million and a 23% growth. And the claims ratio for the risk business is favorable, 27%. I think just to say that the policyholder business presents significant challenges, particularly on value preservation. And you see that much of our effort is to try and minimize the non-monetary minimize the monetary asset, almost the same in US dollars. So there is indeed some growth there in terms of the land and residential properties, in the properties, in reality, not just because the valuer says it is this number. And then you go to the risk business, okay? First Mutual Life risk business. That's a good area in terms of creating profit for shareholders, as you saw that with the 27% increase in EFML. EFML is a product that doesn't require a lot of reserves, so there's a quick release of profit as you go along during each year, and we intend to continue to emphasize that. First Mutual Insurance, almost static. The bigger issue there is actually the fact that this business lost regional business. It used to have 35% of its revenue from the region, but as a result of the shortage of foreign currency and the inability to settle regional claims, a number of the regional cedents decided to do something else. But you will see when you go to the Botswana business that as a result of our presence in a better market, we managed to retain a number of those and move them across to Botswana. So while this is static, you will see a huge growth on the Botswana business, because a number of the same clients just changed the portfolio of insurance from Harare to Gaborone, and they are still in the books of the group. But back to this particular business, you may recall that last year when I addressed this briefing, I said that one of the bigger issues that was facing this business was the loss on the agriculture portfolio, which resulted in an operating loss of 2.4 million. And I said that over a 3-year period, we need to see a turnaround of this, from that loss to a break even to a profit. And after year one, you see that the loss is reduced by about 1 million, from 2.4 million to 1.3 million. It's 1.4 million. It's still a loss, but it's doing what we wanted, what we said we want to see it doing. Measures have been taken there to, first of all, change the underwriting approach in agriculture and to reduce the exposure, and to bring other supporting business where we take the risk in agriculture. The indicators are still bad for that business. As you can see, with a 59% claims ratio, a good one would be around 45%. So that's why if you look at that, you need to reduce 4% each year for the next 2 years, 4-5%, to get back to profitability. And we think that we are moving in that direction. The admin expenses remained almost static, so the real crux of the matter is on that claims ratio, which we need to manage. Move on. Then the Botswana, as you can see, the revenue is growing up by 48%, almost 50%. Much of that is regional business, which was supposed to come to Zim, which went to Botswana. So that moves from 7 million to 10.4 million, and the operating profit doubling from 564,000 US real dollars to 1.3 million real dollars. Of course, for now, we're accounting for them at 1-to-1 with the other dollars. And we think that the claims ratio is a bit low at 29%. We expect it to inch upwards to close to 40%. But that will still remain a very profitable business, even if you look at that. And when that happens, we will reduce the reinsurance ratio to retain a bit more income. So the operating profit is likely to remain around 10% of the top line, which is a very efficient way in terms of a short-term reinsurance. Just to give sense to it, if you look at that now, in Botswana, 54% of the premium is local, 46% is from the other regions. Much of that was also previously directed to Zim, but it's now all going there, most of it. And it's good that we were in that market to be able to capture those clients who were associated with our brand. So the losses in Zimbabwe have sort of helped to increase the business in Botswana, particularly from Zambia and Namibia. Nichols Diamond, new kid on the block. Of course, that's the continuing name of our short-term insurance. Big player already in the market. The revenue going up 29% from 31 million to 40.1 million, and operating profit 81% from 1.3 million to 2.4 million during the same period. It's also affected by, but not as much as the reinsurance, by the claims in the motor portfolio, where because the motor is significant part of the business, they move on. I think it's about 51% of the business is written in the motor class. And where it is comprehensive motor, there have been significant amount of losses in there, but this was actually helped by post-shore, which is the relationship between Nichols Diamond and the Zimpost, mainly writing third-party motor insurance, and the claims for that were not as high as what you find in comprehensive motor, because third-party business is a maximum liability, whereas in terms of the comprehensive motor, for most of the small cars, each prank becomes a total loss. So once it's a total loss, you have reached the ultimate position of making a loss as an insurer. The Minister of Finance approved the measure of the transfer of the assets and liabilities of trust insurance into Nichols Diamond in terms of our application for that business. So this will go a long way in creating a bigger business and eliminating duplication of costs. The integration is underway. We expect the formal part of it to be concluded by the end of the month, but integrating people takes time. So we believe that much of the rest of the year, there will be the cultural diversity engagement in order to put the people together and improve all the delivery. TriStar is struggling because of lack of critical mass, which is the reason for the acquisition. As you can see, whilst the revenue is growing 33%, the operation losses also increased, primarily because of the fact that a significant amount of the claims, again, in the motor book, which is 63% of the revenue is motor insurance, and the losses, now this one didn't have the third part, it was mostly comprehensive cover, and the imports, what we call grey imports, the Japanese cars, once it's something else, it becomes a write-off, and that's the total loss. The adjustment of the premiums was way behind, so the claims were running ahead of the premiums, particularly in the third quarter, before the fourth quarter adjustment. Right, so I've already talked about that. Move on. First Mutual Properties, no need to regurgitate what we already said. Suffice to say that the investment property values kind of represent what it would have been in US dollars, because the movement between 2017 and 2018 is a mere 6 million, after an addition of another 2 million in new acquisitions. The business is performing well to a great extent with an improved occupancy rate in a tough environment. I won't say much about that. Move on. So finally, First Mutual Wealth, which is the investment arm of the group, the revenue going down by 19% compared to last year. This revenue is a function of funds under management all the time. And one of the things that happened is that in terms of accounting, we decided to take out the property portfolio totally from the management of the wealth people. We have an able-bodied system in the First Mutual Properties. So the comparison is not quite a like for like, but more importantly, even the growth on the assets happened towards the end of the year, and the fees are charged at the value of each point of charging. The rest of the metrics remain the same. The cost-to-income ratio, 92% compared to 73% the previous year. The idea for this is to increase the funds under management, and various options will be pursued to achieve the same. I think I'll end here for now and ask William to take you through the audited financial statements. Thank you.
Good afternoon. It's my pleasure to present the financial results for the year ended 31 December 2018. Just to talk about the audit opinion, which I'm sure you're all aware, the auditors issued an adverse opinion for the results for 2018 financial statements, and the reason is because of essentially non-compliance with International Accounting Standard 21, which relates to the effects of foreign exchange rates. And I think, as was mentioned earlier by Tendai for FMP, this was mainly because we had a choice between complying with the law or complying with IFRS, and because of the various statutory instruments, we were obliged to comply with the law. And this is a market-wide phenomenon, and also because there will be brought forward balances from beginning of 2019, it may have an impact on the opinion for 2019, depending on the choices we make with regard to opening balances. Then looking at the financials, the GPW at 181 million was significantly higher than what was achieved, the 125 million achieved in the prior year. Just to mention, on the extreme right, the column on the extreme right is again the pro forma financials, which shows which allows us to like-for-like comparison had we incorporated NDI for the full 12 months of 2017 rather than the 1 month only, which was actually what happened in 2017. And the growth that in the premium written, it was driven by the short term, growth in the short term, as well as in the life company, where there was significant growth for the policyholder through single premiums, as well as growth achieved in the health business. Generally, all the businesses had good growth, but those were the major ones. Looking at the retrocession, this increased quite significantly compared to 2017, again, because of the impact of NDI in the group, which contributed higher revenue and related also higher retrocession. As a result, the group achieved a net earned premium, which at 164 million, which was significantly 34% higher than the 116 million achieved in December. The year 2018 can basically be split into two, particularly for the short term, in that there was relatively modest growth for the first 3 quarters of the year, and then an acceleration in the last quarter, reflecting some of the changes that arose in the economy at that time. Looking at the net claims, these increased by 29% to 89 million, and that 89 million included about 11 million policyholder claims and withdrawals for both years, where in 2017 it was about 10 million, and in 2018 about 11 million, which shows that the growth in the revenue was higher than the growth in the shareholder premiums. Looking at our acquisition expenses, which were just under 3 million compared to 1.5 million in the previous year, this growth, the increase in this expense was mainly driven by one of the products introduced under NDI, which is post-surance, which contributed premium of about 3 million, but also contributed about 700,000 in acquisition expenses. Looking at the movement in insurance contract liabilities, this increased quite significantly to just under 15 million compared to the figure last year, and is a reflection of the single premiums that were received by the policy holders, and this is money that was transferred to the policyholder account, resulting in an overall underwriting result of 43 million compared to the prior period figure of about 31 million. The rental income for the group was enhanced by the incorporation of some rental income from NDI of about 500,000, whereas in FMP the figure was just under 8 million. Here we've got about 7.1 for FMP after eliminating the intra-group rental. Our admin expenses have gone up quite significantly. Some of that, some of the growth a lot of that growth happened in the last quarter of the year. Again, a reflection of the situation in the market, and I'll cover a little bit more on some of the contributors to the increase in admin expenses. Looking at our project costs, the group is generally always undertaking various projects to either expand or even restructure some of our operations. In the last year, most of the project costs related to the acquisition of NDI, whereas this year the major initiative related to the restructuring of the ownership or holding structure of the property portfolio. It was previously held in various companies, 8 companies, and in an effort to improve efficiencies, and other costs, they were now relocated to two companies, and hence the some costs that were incurred there. Looking at our provision for credit losses, these were at 690,000, an increase compared to the prior period. Part of that, the increase compared to last year, was that there were some recoveries in 2017, particularly under the property company, whereas this year we did not enjoy such a benefit. And also there was greater focus under IFRS 9 in terms of looking at our provision for credit losses. We had always had quite an aggressive and prudent and conservative reserving structure, but because there were some slight increases, but the main reason is actually because there were no recoveries at the same level. And overall, we attained an operating profit of 11 million, which was an improvement on the 8 million for last year. And looking now on the other side of the income statement, more on the investment income, and the various components. In terms of the investment income, we managed to keep it. It was more or less sustained, even though compared to the last year, and I'll cover that in a little bit more detail in another slide. Looking at the fair value gains on investment property, I think this matter was previously covered, so I won't dwell on it too much. And naturally, most of that, the investment gains are for the account of the policyholder who holds a large part of the investment portfolio, and hence the transfers combined of about 27 million to the policyholders in the life company for the year, resulting in a surplus before tax of 24.8 million, which was a significant, almost a 10 million improvement on what was achieved last year. And after taking into account tax, the group had a profit of 17.6 million compared to 12.2 million. Thanks, ma'am. Just looking at some of the line items in more detail, we first starting with the investment income. I think one issue to highlight there is the dividends received, which were mainly arising from dividend in species that were received from some of the counters on our portfolio. I'm sure you are aware that there were some companies that declared significant dividends or had demergers of sorts which were processed as a dividend in this case. And also, there was still some fair value gains on the equity portfolio, but at a lower rate compared to last year. Then looking at some of the expenses, it can be a little bit misleading because while we're looking at year on year, most of the increases happened in the last quarter. So there has been an increase, significant increase in a lot of the expense line items, particularly those with an imported component. And you find that generally a lot of the line items do have an imported component one way or the other, and it has had an impact. So you'll see things like computer expenses and marketing expenses were going up. For the IPEC fees, that is more a reflection of the increase in the premium that was written in the insurance businesses. And some of the other ones, like the depreciation and amortization of software, it's just demonstrating our continued commitment to invest in the future of the group through capital expenditure, particularly in IT. For the staff costs, these increased compared to the prior year to just under 20 million, driven by a number of factors. Some of them, there were some modest adjustments, I would say, in the last quarter of the year. And there were also some new departments or new initiatives that led to the increase in the staff complements that contributed to the increase in staff costs overall. Looking at the statement of financial position, I'll just touch on a few highlights, starting with the equity investments, which we almost doubled to 105 million. Part of that was due to the combined return in terms of investment income and the dividends in specie, which were basically listed counters, that contributed to that, as well as they combined contributed about 30 million. And then there was also a purchase of some of assets during the year as we tried to protect or preserve the balance sheet through investment in non-monetary assets. It's difficult to fully achieve the objectives that we had because there's a requirement to comply with the regulators, both the IPEC and the Ministry of Health, that require for the group to have, for insurance companies to have a significant part of their portfolios in prescribed assets as well as in money market investments. Some of them are to assure in terms of liquidity and ability to pay claims. So that limited us somehow, but we are happy to report that during the course of the year, the group managed to buy about $10 million worth of Afrexim bonds, which are listed in Mauritius, and that's part of the reason increase in equity investments. The debt securities at amortized cost, we had a slight restructure of how our money market or monetary assets between debt securities and cash equivalents, and you'll see the decline of about 10 million. It's sort of reflected in the increase in cash and balances with banks, as we were trying to prepare to invest more in alternative investments, so that it's better to keep the money in cash and balances with banks rather than in debt securities. And we're also trying to limit our exposure to debt securities to the minimum that is required for regulatory purposes, so that we can minimize negative real interest rates on that part of the portfolio. Another noteworthy aspect on the assets is the insurance and other receivables, which were static or went down slightly, which may be a surprise given that our revenue increased quite significantly, the premium. But this was because of more follow-up or aggressive follow-up, and also with the follow-up with our clients to try and receive the premium earlier, and we are quite pleased that we were able to limit the increase in the receivables. Looking on the liability side, we can see there that the amounts that for the policy holders increased quite significantly, reflecting their increased contributions. Like for instance, the insurance contract liabilities increased by almost 31 million, which is a reflection of the increased contributions as well as the positive investment outturn for the policy holder. And then our borrowings, I think the only one is really at FMP, and this loan was pretty much repaid in Q1 of 2019, and as it was being paid off, that's why that balance was going down. Looking at the consolidated statement of cash flows for the year, the group was able to generate significant cash flow from operations through increased operating profits as well as managing prudent working capital management, which resulted in cash generated from operations of 29.2 million, and most of that was invested with the various investments, particularly on the equities, as well as other and some properties as well, about 18.5 million, and this continues to be a focus area for us in terms of reducing our exposure to monetary assets. And in a way, one of our challenges is that as we invest the money, there's always new money coming in because we're an insurance business, and generally the premiums come before claims. So this is something that is to our advantage, and we'll continue to focus on investing in sustainable assets. And we closed the year with significant cash and cash equivalents. Okay, just to touch on a bit more about the impact of the post-balance sheet events and how they would impact affect the group. Following the monetary policy pronouncements issued by the governor, and we'll just provide some sensitivity analysis just to show how the impact on the group on the balance sheet of the group at 31 December. Okay, we do have significant US dollar or Nostro assets as well as RTGS, and the portion in white where we tried to split, we'll see that there are monetary assets which are mainly debtors and cash and balances with banks, whereas the non-monetary assets, particularly on the US dollars, they are mainly investments in Botswana as well as in Zimbabwe. And for Zimbabwe, it's mainly the Afrexim bonds. And for the Botswana side, most of the money is actually in cash and balances with banks. And the group was in a positive US dollar position of 4.4 million at the end of the year. And on the right side, where in pink, we looked at two scenarios. The first one is the opening interbank rate of 2.5, and the second scenario is the closing interbank rate on the date of the board meeting on 10 April of about 3.1. And we can see that the impact on the equity for the group was to increase the equity or improve the equity of the group. Then we also felt that maybe it's important to try and separate those amounts between what is in Zimbabwe and what is in Botswana. And what this shows is that we've got significant assets in Botswana, which are real assets, and on the Zimbabwe side, as a group, we're still in a positive net asset position overall in terms of the US dollar position. Then looking at the dividend, the board of directors met on 10 April, and the directors recommended a dividend of 29 cents a share, and which amounts in total to RTGS 2.1 million. This dividend is exactly double the dividend that was paid last year of 1.050. We have previously mentioned in the past that our aspiration is to pay a dividend based on the tax-adjusted operating profit of the group, and we are more or less, and our objective was to pay 25% of the tax-adjusted operating profit, and this dividend represents that 25% of 2.1 million. And also the board is satisfied that the group has ability to continue to operate for the foreseeable future, and has the capacity to pay and sustain the dividend, this dividend. Okay, I'll hand back for the look at the outlook and priorities.
Thank you, William, for the financials. I will briefly outline our view as to where we think the situation is going. On the key matters, as you saw with our insurance business, the board approved the decision to relocate the insurance head office to Botswana, because by the very nature of that business, it's international. So there is a transaction underway. It hasn't gotten to the stage where we can issue a cautionary notice, but significant progress has been made. The intention is to create a reinsurance holding company, which will hold the two reinsurance companies currently, the one in Zimbabwe and the one in Botswana, and it will be based in Cameroon. It will give it access to international markets and also better liquidity and currency stability. The capital raising that we are doing to capacity that business so that it will have a total capital of about 20 million US. We are in the throes of raising between 6 and 7 million US by disposing of a stake of nearly 30% in the Botswana and Zimbabwe businesses. We retain control, but we have partners who will end up with 30% of the equity. This will give us about $7 million more to put on the balance sheet, and we believe that it will give us a bigger impetus in terms of underwriting risks from the region, particularly in SADC, which is Mozambique, Malawi, Botswana, Tanzania, Zimbabwe, and Zambia, as well as Namibia. On the local scene, we incorporated the microfinance business toward the end of last year. It's still operating internally, but it will soon be out in the market. This was a result of the approval of the financial inclusion strategy by the board of First Mutual Holdings, and we see microfinance as one of the key pillars of financial inclusion. You would have seen our efforts in the market with regards to free financial education, but the microfinance business will be the front foot in terms of the financial inclusion strategy. We've also gone into funeral services. You would have heard First Mutual Properties buying some property in the avenues near the hospitals. That's intended to be the headquarters of the First Mutual Funeral Services. Some people may wonder why you want to get into that market, which seems to be oversubscribed. We have taken a philosophical view of that, which says that we need to make the funeral business a little bit more funeral than parties, which they look like these days. And we believe that we'll be able to do that and create that space in the market. In addition to that, we continue to use the digital technology to increase interaction with clients and process efficiencies. That has been seen particularly in the health business, where the process of claims by most service providers is now on a biometric basis. You just put your fingerprint and you move on. Then the consolidation of TriStar into Nichols Diamond is underway. As I have explained earlier on, we believe that it will be concluded during the course of the year. And we continue to focus on growing the revenue and containing the cost of doing business. One of the things we take seriously is that there is no environment where there are no good businesses, despite what people say about the environment. Every marketplace where you go, there are successful people and successful companies. And the real difference is around your attitude towards what you are doing and doing something about it. And we believe that we would like to be going beyond, is in line with our payoff line, in delivering value to our stakeholders through commitment, innovation, cost containment, and focus on profitable lines. Thank you very much.
We will now go into the question and answer session, and like I did say earlier, I'm sure we'll have a robust discussion like we had with First Mutual Properties. So the same modalities apply. We have a roving microphone, and if you could identify your name, which company you're from, before you ask your question. Thank you.
I'm Alvin Chidzonga from Comerton Consultants. With IFRS 17 on the horizon, I've seen you highlight some good numbers in terms of your growth rates. That's maybe for First Mutual Health, 15%, and other subsidiaries. Have you done any simulations maybe for these numbers with reference to IFRS 17? And maybe after that, would you put the business, the whole group, maybe being able to be compliant with Solvency II, especially Pillar 1 and Pillar 2?
Thank you very much. Thank you. Thank you very much for your question. We haven't actually done IFRS 17 simulations, but what we can say confidently is that with an additional year, having added to the implementation of IFRS 17 to 2022, I think, we have set up a working party that will start working on it, but we haven't tested these numbers. But because by the way we do our business using the actuarial control cycle, we believe that our processes already comply with our thinking to a greater extent with IFRS 17, but we have to test it properly in terms of its specific requirements during the next 2 years. This year, working party, 2020, the models, and then 2021, before ahead of the implementation.
So just wanted to add that we're also engaging the providers of the business applications to make sure, because There also, a great part of it is related to our IT systems. So we already started that engagement to make sure that they are compliant as well. But this is not it's a process, not an event.
Hi, Brian Moy again from Ernst & Young. I wanted to comment on, I know you made a comment that you're moving away from fixed income instruments to run away from negative interest rates. But then we see that about a third of your balance sheet is in equities. Now, you mentioned that you're buying those FXM depository receipts, which is offshore, which could be safe. But a lot of the equity market in Zimbabwe currently sort of saw a bull run because of people running away from hard currency and moving money into the equity market. So how are you guys hedging the risk of the equity market normalizing going forward? Because you had an 89% growth in your equity investments. Is that your real return or?
Okay, thank you very much. I think it's quite a mouthful. I will start with the issue of the monetary assets. We do have a significant quantum of monetary assets, primarily for the reasons of compliance. While we make an effort to buy other assets, including alternative investments, which we didn't talk about, we are constrained by the fact that we still need to comply with prescribed assets. That's the first part. Insofar as hedging against the equities falling or not aligning to real value preservation, that is a question of the fundamental economy. The economy itself, the medium of investment, is what really matters. However, what you do is that if you look at the stocks that are held, the selection is centered around those stocks that can retain value. And one of the things you saw in the FD's presentation is the fact that significant amount of investment return was paid as dividend in specie, which shows you, it points you to where the equities are held. So my answer to that would be, in simple terms, hold the blue chips and then hold export counters. And if you hold the other ones, they must be showing strong fundamentals and prospects for growth. So the fund managers are properly directed by the investments committee to deal with that.
Any other questions?
Just a deep analysis into your Botswana business. What's the retention ratio for your premiums? Are you sending all the money maybe back to Zimbabwe, or through your retransaction arrangements, you are passing it on to other reinsurers? Thank you.
If you looked at the slide, the reinsurance ratio is 40%. So we retain 60% of the premium in the who are our securities. It's mainly the international reinsurers, retrocessioners out of Botswana. There's no inward bound retrocession into Zimbabwe from Botswana for the reasons that we're talking about of the ability to generate foreign currency pay. So the primary securities are international players in Europe, Middle East, and Latin America.
Then lastly, you've done pretty well maybe in Botswana, where a lot of Zimbabwean companies have not fared well. What's been your winning strategy in the past, and maybe looking into this sustainability going forward? What are going to be your pillars going forward?
Thank you. Without divulging much of our strategy, I think it's a correct observation you make. But 6 years ago, we requested our shareholders, they are here today, to give us capital, because one of the biggest weaknesses of Zimbabwean companies going into the region is that they want to start a business with no capital in a regional market. So first of all, they never reach their critical mass. And secondly, they tend to pump up expenses ahead of creating a business. So when we went into Botswana in 2013, 6 years today, I went around the market and I was soliciting for business. And the answer that I was given by a number of citizens was that we don't give business to somebody who has no credit rating. And I implored them to say that there's always a starting point. A new player will never have a credit rating. So I requested for small shares in their business to demonstrate our ability to service and pay claims. And eventually those shares increased slowly but surely. So the first 2 years we were making a profit. Then in the third year we're breaking even. And even the head office was not charging any fees for that business to incubate it properly.
Maybe finally, you gave me another lead. In terms of your underwriting processes, you spoke about maybe your claims ratio being a bit high, and with an intention of actually reducing that. Would you see yourselves maybe incorporating telematics, maybe in your short-term portfolio?
Please repeat yourself.
I'm saying we've seen you highlight that your claims ratio, were a bit high, maybe at around 51%, maybe with an intention of reducing them to 49% or even below. Would you see the value of incorporating telematics actually reducing those claims ratio, especially on your short-term portfolio?
Yeah, thank you. I think there are two approaches to underwriting. First of all, I'll start with the reinsurance, where we said last year we were on 63% as a result of our significant exposure to agriculture. And the way we were taking retrocession, we've already changed that, so we see that coming down. Now, in terms of the rest of the short-term insurance, particularly the direct writers, the B2C businesses, the Nichols Diamond particularly, we see that coming through, because as a big player, we will not take any price. We are going to underwrite business with the correct price in the marketplace, because what has tended to happen in Zimbabwe is that there's emphasis on the top line at the expense of a good price. If you see when we are addressing you today, we're not talking much about the top line, but the operating result. So we will go all the way to ensure that as much as possible, the price is right. But the volatility in the market may still militate against that. But we would like to say, even in that space, we should be the best in terms of the underwriting outcome. It may not come down to the 40s soon enough.
Any other questions? Okay, if we don't have any more questions, we would like to thank you for joining us and discussing with us our results for 31 December 2018, and would like to invite you to join us for snacks and drinks at the back of the room. And like I said earlier, we do have the team here should you find that you have other questions that you'd like to ask. Thank you.